Hi, this is Tom Sullivan, head of small business policy with the U.S. Chamber of Commerce. I am joined by two wonderful individuals at H&R Block. One is a former small business owner, and today we are going to cover your small business financial playbook, advisors, entity structure, and tax compliance explained. All right, Jody, let's start with you. So when you were starting or growing your business, how did you actually find the financial advisors you needed in order to be successful?
Yeah, that's a great question. I would say what I found out early on was it was not me and my partner that were the right financial advisors for our business. Um, I think what it was is, and I can't stress enough, is you got to know you and your business partner if you have one, but you have to know what your goals are, what your objectives are, and I think you really have to push on that partnership. So when you reach out, be honest and open about what you're trying to accomplish with your business, but also what your weaknesses are, like what drain you of your energy. And so we interviewed several people locally. We interviewed some remotely. We landed on a kind of a local organization, local firm to help us. And to be honest, they weren't the ones we ended with. Like we kind of outgrew them, or they didn't meet expectations, but they felt right at the beginning, and they helped us kind of move the ball. But we learned a lot as we grew through our business.
Well, that makes a lot of sense. And Carl, I'll turn to you because what I heard Jody talk about was relationships. And from where you sit, in your perspective, what are the essential financial advisory relationships that most growing businesses need?
Yeah, that's a great question. And as your business grows, um, you're going to interact with a few key advisors along the way. Today, we're going to focus on kind of three main ones. Your first one is your tax advisor. This is someone who's going to help you not only stay compliant, but they're also going to help you with proactive tax planning. Your second one is kind of your payroll and bookkeeping expert. This may or may not be two different people, but their kind of role is once your money starts moving in and out regularly, you really need to focus on that accurate and consistent, record keeping. And then finally, it's always good to have an attorney on hand, especially for kind of your state tax law issue or state law issues, um, because there's always things that pop up, and having one in your corner is always good. And to be honest, you hear that, and it can feel overwhelming to have. Well, that's a lot of people. But good news is it doesn't have to be complicated. Many business owners choose to kind of streamline this by using like an all-in-one service or a firm that kind of handles all this for you. The point isn't really about size, but more about kind of reducing the friction. So you're not juggling all of these different people who aren't communicating with each other. Um, and so you may then be asking yourself, well, when do I bring these people on? And many owners kind of get help early simply because they just, don't have time. They're running the business, finding customers, managing employees, and all these kind of administrative tasks can kind of pile up and get overlooked. So um, you kind of evaluate your level of comfort. So in the very beginning, you may try to manage your own books, but maybe you have no employees or just one or two, so that's pretty simple. But as things grow, it kind of can get out of hand. And so finally, that relationship piece, you have that information and you look at, okay, now I need to figure out who exactly I need to pick. And the best advisors don't just process forms or run numbers. They take the time to understand how your business actually works. They know your goals, your challenges, and even your blind spots. And when a big decision comes up, whether it's kind of a hiring issue, expanding, or changing even how you're structured, they're able to kind of give you informed, practical guidance because they know your business. And that's when an advisor stops being, just a vendor or a company, but really being part of your team.
Well, thank you. And in that description of how the ideal advisors are kind of this one-stop shop, you did mention the question of how is your business structured, and at different parts of your business journey, should you be thinking about changing that structure, and what are the advantages and disadvantages? And gosh, it's so complicated. I mean, there's C corps, S corps, LLCs, sole proprietors. So, Jody, how do you navigate through what type of structure you should have? And if you could just kind of walk us through the journey that at particular times, perhaps it's worth considering changing your business structure.
Tom, that's a great question. Hopefully, some people will learn what not to do by my examples I'm about to walk you through right now. So, my business partner and I, we incubated like, hey, we want to go into business. We want to do something. We weren't quite sure what it was. So he's a smart guy. I thought I was a smart guy. We kind of came together. And so I took over the responsibilities of kind of setting up our business. And while we were hunting down like what we wanted to do with a business and where we wanted to grow. So I threw open our LLC, got that stood up real quick, did our DBA, and then we started kind of looking at what we wanted to do. We didn't have any revenue coming in. We didn't have any income. We didn't have anything. And then we ended up buying a couple of businesses, a couple of franchises, and I kind of left them on the shelf. I just left them there and we started making money. And then I realized like we're losing money by not looking at kind of the entity formation structure. So what I would say there is immediately we started, once again, the financial advisor we brought on board brought it to our attention about a year and a half too late. Like, hey guys, maybe you should be thinking about actually setting up an entity structure. And so we actually migrated to an S-corp because effectively what we didn't realize is we had to pay all taxes on all earnings as an LLC, a multi-member LLC. Once we went to the S-corp, we were able to take kind of reasonable wages out, and then everything else was not taxed at the standard FICA rates, if you will. So I would say make sure you know what you want in a business, what you want to do with your business, and work with somebody who's trained in this. Like I wasn't trained in this. Like I was reading on weekends and nights and things like that. And I didn't reach out to the advisor in time. So I lost money for me and my business partners for about a year and a half, if you will.
Well, thank you, Jody. And Carl, come back over to you because Jody really kind of hit a key point, and that was like it depends what you want. But you don't want to get in this loop where your advisor is saying, well, what do you want? And the small business owner is saying, well, what do you think I should want? I mean, you just don't want that disastrous loop. And you have experience in advising at different points in a business journey. There are certain risks you want to mitigate by your business structure. Could you walk us through that a little bit?
Yeah, so there's when you look at business structure, there's three real things that we consider. Well, there's a lot more than that, but three big ones that we kind of want everybody to think about. That's tax, that's liability, and that's compliance. And so for tax, you have to look at, so do I want, say, a pass-through model, which we'll talk a little bit more about that later, but essentially, do I want to just pay tax one time on that income? Or do I want a double taxation model where the entity has its own tax return, pays tax on the income, and then any money that I get as the owner, I'll pay tax on it later? That has its advantages, has its disadvantages. You kind of have to know what you want out of that. And honestly, the smaller your business is, the better pass-through taxation tends to be, because with pass-through taxation, you have simplicity, and simplicity is always great when you don't have a lot of income, or even you have losses because you're just starting out. So then we move to liability, and liability is almost always the breaking point when we look at structural analysis. And for things like sole proprietorships, partnerships, and when we say partnerships, I'm just going to stick with general partnerships, not all of the branches like limited partnerships and things like that. Um, for those entities, and they're not even really entities because they're basically an extension of yourself. For a sole proprietor, you and the business are one and the same. All of your personal debts are really subject to the liabilities of the business. If you get sued, your personal assets could be at risk. There's nothing really there to protect you. Same thing if you're, a general partner in a partnership, you don't really have a lot of protection there. When you step into, say, a limited liability company or a corporation at the state level, that liability shield comes into play. And um, there is some confusion. A lot of people think, oh, this is this wonderful thing that's going to protect me absolutely, and I'm just bulletproof. But that's not necessarily the case. We don't want people to think that they're absolutely safe. But it is a very strong shield that can protect you in cases where people come after your assets. And so that is the big one we think about is liability. And then finally, we have compliance. And for compliance, we're thinking about what sort of administrative things do you have to do for the business? And this could be things like, do I have to have annual meetings? Do I have to have a board of directors? What kind of annual filings do I have to have? Are there state fees I have to file and pay? And the simpler entities like sole proprietorships, partnerships, they don't have those things. Then you transition to like a hybrid model, which is what an LLC is. It really doesn't have many of those. There's some state filings and some annual fees that you may see, but you don't have like the annual meetings and the board of directors and the bylaws and all of those things that corporations have. So it's kind of the middle ground. But if your business gets to a point where those things are necessary, because of the complexity and the size, say, like at H&R Block, we're so big, we need that board of directors. We need those meetings and corporate minutes and things. It's all dependent upon your business's facts and circumstances.
I really appreciate you talking about how there's really no such thing as 100% protection. But when you establish that relationship with a financial advisor, their job is to minimize the risk.
Absolutely.
So almost bulletproof, but not no guarantees of absolute bulletproof. And we've talked a lot about kind of what happens in a growth journey for small business. So let's talk about the exciting and terrifying part of growing a business, and that is adding employees because there are tax consequences to that. So, Carl, can you talk a little bit about payroll taxes and FICA and FUTA and all those acronyms that keep small business owners up at night? So perhaps your advice can kind of calm down some of the anxiety when someone's both excited to add new employees, but then terrified because of the tax consequences.
Yeah, I think part of the fear that business owners have is just that there's so many things they have to, take into account for payroll taxes. When in reality, it's really just a few things. Um, when we think of the big one, that's FICA, and that's going to represent your Social Security and Medicare. For that one, we're looking at it's 15.3% of the employee's wages up to a certain point. Um, and a portion of that's Social Security, and a small portion of that's Medicare. I won't get into the dollar amounts for anybody because it's a little bit too much for today. But the main takeaway is that 15.3% is split evenly between you, the employer, and the employee. So each of you are going to pay half. Um, the good news is for the employer, the half that they pay is tax deductible. So you get that benefit. So not only is the wage deductible generally, so is that amount you pay for that tax. And so in the process of FICA, you'll withhold the employee share and then you'll deposit that along with your share. It's simple enough. Then you look at the next portion, which is FUTA, and that's federal unemployment. And the FUTA is a acronym for the federal law that puts that into place. And that's just a small percentage of the first seven or so $1,000 of the employee's wages. So, oftentimes if you have an employee that's a full-time worker or a pretty well-paid worker, they're going to meet that first quarter. It'll be over with. You won't have to worry about it again the rest of the year. That one's going to come with the same deposit. Once as you're hitting that, you make those deposits. And then um, finally, you have income taxes. And income taxes, you don't have any payment responsibility in there, but you have a withholding responsibility. And you just use the employee's W-4 to figure out what to withhold, and you make deposits with the IRS throughout the year. There's certain schedules that you have. Usually it's either, semi-weekly or monthly. And it kind of depends on how you pay. your employees. And then with those kind of paying and withholding and all of that, you have a couple filings that you have to take into account. Generally, most employers are going to have a quarterly Form 941 that takes into account the FICA portion and the income tax portion. And some folks, if you're small enough, you may qualify to do that annually using Form 944. And then for FUTA, you have an annual filing, which is Form 940. That's generally all you have to do. There's a few more things you have to do at the state level, but it's not too bad when you really sit down and you put in your calendar, these are the dates and the times that I have to do these things. Or if you don't want to mess with it, that's what a payroll professional's for, and they handle all that stuff for you, and you just have to worry about running your business.
Well, Carl, thank you. You certainly made it less scary. Jody, I want to turn to you and build on some of your experience as a small business owner. What was the learning curve like for you when you added employees? And did you have someone like Carl there with you, kind of holding your hand through the process?
The answer is no. And for everybody who's listening that is a small business owner, I gotta give props to Carl because what he just said, and it's like it's no big deal. It's a big deal. Like, I mean, filing quarterly, putting a reminder on, like, I didn't open a business to do payroll and W-2s and quarterlies and annuals. So although when we did it, I did it myself. So basically I went out online. I started using kind of a DIY version. I did it for about 3 quarters and hated every minute of it because I felt like my time is better spent going somewhere else. So unfortunately, and this kind of goes back to my earlier story, when I went to my advisor, they didn't offer the bookkeeping. They were really in the tax space. So they didn't offer bookkeeping. They didn't offer payroll and things like that. So that's what made me really go into myself and like manage it myself. It wasn't hard, by the way, just so I want to be honest with you. It wasn't super hard, but it was time consuming and you had to be available and you had to issue the checks and that kind of stuff. So I actually, my business partner and I reached out and I think, again, alluding back to a comment Carl said, we found a solution that was all in one. So they had an entire organization that did our bookkeeping, our payroll, and our tax prep. It merged it together, and they ended up really becoming my partner. So what I would say is it's not hard. Carl's right. It is a little overwhelming and daunting because it is a reoccurring task that you have to add. But it was also a blessing not to have to do it. And knowing that everything was being filed appropriately, all of the right documents were out there. And I'm sure Carl can attest to this, but some of those documents you have to use for your work comp statements and things like that, like those 941s, like you have to pull those together to show your payroll. So we went to a fully managed bookkeeping, payroll, and tax.
Are you better off from the pain you had to go through to choose and ask a bookkeeper the right questions to select them and build the relationship?
Way better off. Like I can't even describe it. There's the time back for me. Like what I've always said is, you can't buy time. So do I want to do this or do I want to do more with the business or do I want to do more with my family or something like that? And these were tasks that allowed me to kind of reposition and utilize my time. There's also this sense of, I know it's being done right. And my partners are helping me drive those decisions on when to do certain things and how to do those things versus me constantly trying to stay up on tax laws. And keeping in mind, I should have alluded to this. I'm an accountant. Like I graduated in accounting and finance degree. And so it was nice taking those and offboarding them to somebody who this is what they do and then reporting out to me what it means to our business.
It's great advice and great experiential advice as well. Carl, now I get to play the small business policy nerd that I am during my day job. Uh, we know that over 80% of America's small business owners don't have employees. So can you walk us through the non-employer or the self-employed taxes situation and specifically what does a self-employed business owner do and know to file either quarterly or annually and what happens if they mess up and just don't get it right?
Yeah. So our system, our tax system is a pay-as-you-go system. So for employees, that's real simple. The employer takes care of it, and you move on with your day. File your tax return at the end of the year, no sweat. For employers, it's a lot difficult because we have what's called self-employment tax. For self-employment tax, Really, that's an annual thing. You do that when you file your tax return, and it's calculated on what's called Schedule SE. Some of you may be familiar with that because you're either a sole proprietor, a partner, or an LLC taxed as one of those. Um, Good news is if you're an S corporation or a C corporation, you can ignore this part because you don't have self-employment tax, and you can laugh at all of us who have to pay it. So, um, but for self-employment tax, it's assessed after you've made $400 in net earnings from self-employment. So once you hit over that $400, you're going to have to start thinking about self-employment tax. And generally, because we're a pay-as-you-go system, that means you're going to have to make estimated tax payments. Now, for individuals and businesses that are pass through, that generally means if you expect to owe $1,000 or more, and you don't think your withholdings from all sources are going to cover that liability, you're going to be required to make estimated payments. If you're a corporation, that threshold moves down to $500, so just a little bit lower. Those payments are due quarterly, and you use what's called Form 1040 ES to kind of calculate those. It used to be you would have to fill out that form and mail it in and send your payment in with the form. Now it's all done online. We don't send that form in anymore. We just kind of use it as a worksheet if you're sitting there in the office by hand working it out, or like for us, our tax professionals have software where they can calculate that all out for you and figure it out. But main thing is each quarter we're going to try to estimate what your income is going to be for the year. So it is kind of a guessing game. If you're a new business, it's really a guessing game because you may not have historical data to figure that out. Um, but the good news is, as we move through the year, we update that estimate with each payment. So on a quarterly basis, we rerun that calculation, we figure out what your estimated payment should be, and then hopefully come tax time, you don't owe any more or self-employment tax because you've already covered it. Now, if we didn't do the greatest of job estimating, then you may owe a little bit, but hopefully the goal here is to cover that amount. Now, if you don't make those payments, there's a pretty stiff penalty, and that penalty is the federal short-term rate plus the IRS rate for the quarter. So that can be a moving target, and the penalty is assessed for each quarter that you missed a payment. So if I missed the first quarter payment and then the second quarter payment, if that IRS interest rate has changed, then my penalty will not be the same for those 2 quarters. So they're going to be tracking at a different amount. And then you also have interest on top of that. So as you can see, this kind of gets confusing because now you're keeping track of 2 different quarters and you're trying to figure out, okay, what's the interest on this quarter, the interest on this quarter. And so it's really the best idea is just to meet with your tax professional on a quarterly basis, and you avoid this headache altogether. But if you don't, you can reconcile it at the end of the year, pay it, but you're going to pay that penalty and the interest with it.
Well, this is March and it is basketball season. So we are going to shift format into the jump ball. Now, luckily, I'm very short, so I would never get a jump ball, but the two of you are going to take some of the questions that have come in live as we've been explaining some of the things for our viewers. So when I toss up the question, just like rate, you don't have to jump and try to get it because that would be really awkward on video. But if you could just raise your hand, then I'll call on whoever raises first. All right, number one just came in with the One Big Beautiful Bill Act. Have there been any changes for small business owners who work out of a home office?
Got me, Tom?
Oh,
Yeah.
Carl gets the first jump ball.
So yeah, this could be fortunately or unfortunately, depending upon how you look at it. But the bill does not make any changes to the home office deduction. So your small business owner that has a home office or completely works out of their home office, they could still claim that deduction as long as they meet all the rules. We still have the safe harbor that's always been around to make that calculation easy. The one quirk that has come about is that the employee business deduction has been permanently removed. So it's gone forever. And a lot of employees had used that in the past to claim a home office deduction. So that is really the only thing around home offices that has changed.
Well, thank you. I'm going to take the referee jump ball prerogative and on behalf of the U.S. Chamber of Commerce, tell all of our viewers, ask your tax professional about the advantages small businesses have under the new tax law. There's a lot there. If you don't ask, you are leaving money on the table. So please, please, please ask your tax advisors about how you, as a small business owner, can take advantage of the new tax law to either expense different things, grow your business. It's a long, long list. And there's actually advantages for your employees as well. And I know that goes far for small employers who look out for their employees when those employees have to file their taxes too. All right, another question coming in. We'll get ready with another jump ball. What is the best time to elect S-corp status for your LLC? And does H&R Block advise and help businesses for that election?
I want to jump in, but I need Carl behind me on this
Go
one.
ahead.
Oh, okay. Well, so then you get the ball first, and then before it goes out of bounds, Carl will get it.
I'm going to pass it. So, as it was described to me, and by the way, there's two parts to this question. So let me jump to the second one because I think that's important. Yes, Block Advisors, H&R Block will give you guidance and help support the best decision for your taxes. Like that's what we do. Like come to us and we will talk to you about, those situations that may arise retro or forward looking. About 40,000 or higher is when I really think you should look at the S-corp, right? And what that means is, and what I want to be clear on is reasonable wages. That's a clear assessment and kind of test you have to run on when you can actually say, I can make a reasonable wage. Like if depending on the size of your business, you can't take $100,000 out if it's a business that you should probably be taking 40 out of. But I think around 40,000 is when it really starts to get a meaningful amount. Carl, would you agree or disagree? Sorry, friend.
Yeah. So what we really want to look at is like Jody said, that range is where you really start to look at it. But we're looking at whether the savings from no self-employment tax is really going to be helpful. So because if you're performing services, you have to draw a wage, and that wage has employment taxes, which are the same as self-employment tax if you look at what the amounts are. If you just said, oh, I made $30,000 in business profit, if I switch to an S-corp, I'll benefit. Well, if I have to pay myself $30,000, there's no benefit there. Well, there's a small benefit, but anyway. So what we're looking for is once you pay yourself a reasonable salary, is the income that comes in on top of that you won't pay self-employment tax on, is that going to save you enough to justify the administrative cost to make the change?
Really good description of both the experience and the compliance. So thank you both of you. You've got another one came in that their small business didn't generate revenue until 2023, and it was pretty small at that point. Can that small business still claim research and development expenses?
I know this one is one of your favorites, Tom. So one thing that's unique about research and development costs is that there's been a credit available and there's a deduction. And the deduction was around, then it went away for a few years, and now it's back under the one big beautiful bill. And a unique part about that is, and one thing that Tom likes to tell people is that if you pay wages as part of that research and development costs, those wages get included in that deduction and or credit. And so a lot of people overlook that thinking, oh, that's just wages that we don't get to count. And so you have to look at one, which is better between the deduction and the credit. If you're very small on the revenue, so we're looking at that menial part when they started making revenue, it may not be beneficial to take the deduction because if you don't have enough income to absorb the full amount of the expenses, then what you have to do is what's called amortizing. And then you have to basically take little bites of that Apple over 5 years. So we're going to just stretch that out. Now, if we take the credit, then what could happen is that credit can carry forward for up to 20 years and just waiting for you to have income. So if you carry that forward and in 5 years you have, oh man, we had a banner year and we finally have the income to absorb that credit, that could be where that amount is really, helps you. So this is where a good tax advisor comes in, because there's a lot to this. That was a very basic explanation, but there's a lot of little quirks and nuances to how these costs work. But just wanted folks to understand that, hey, this is a powerful deduction if you're putting in the investment to develop a prototype, a new product line, a new system, some software, all those kinds of things could qualify for this if all the rules are met.
Oh, thank you, Carl. I actually was really surprised by the number of members of Congress who did not understand that R&D expenses applied to wages. And you can bet that at the chamber, we made sure that all the lawmakers understood it, and that's one of the reasons the law got passed and that R&D expense was made permanent. Another question came in. This will be a good jump ball, I think. So you guys get ready here. This sole proprietor has about 500,000 revenue and says that they're continually in a high income bracket, high tax bracket. It just seems that because of that, they never seem to get ahead. And they insist that they look at all the possible deductions. Are they missing some fundamental questions they're not asking their tax advisor that would help them actually come out a little bit more ahead in the future?
Carl, you want that one or me?
I think this is another tandem one. So I'll let Jody give a practical, and then I'll give some things they can do come tax time.
This is the most gentlemanly jump ball I have ever experienced. Jody.
Yeah. I would say if you're making $500,000 and you're in a sole prop, you should talk to you should talk to your tax advisor immediately. Like, I think you need to understand what those advantages are and which way to go. I wouldn't tell you exactly how to set it up, because I think you need to know more, kind of going back to my earlier statement, what you want to do with your business, where your business is at in its life cycle and things like that. Because as Carl has mentioned a couple of times, there's a lot of requirements based on what you're going to do with your corporation, or if you pivot into a kind of an entity structure like that. But I would say definitely you should reach out to a tax professional to help you look at how you're structured currently, what you want to try to do long term.
It's really, really good advice, not just about looking at what you spend and what you earn, but talking with the tax advisor about where you want to go. I'll bet that there are a lot of viewers who have not thought of that, and it's a really great approach. Carl?
Yeah. So, and one thing folks kind of struggle with is before you go to your tax appointment, aside from structural analysis and things like Jody you're talking about, I would ask that you make an income statement, that you make a cash flow statement. Let's have those things ready. Really, I'd ask you to do it every quarter, but at least let's do it before the tax appointment. Because what your tax pro can do is they could sit down with you and they can go through those two things, and they could see every single expense that you had during the year that's potentially deductible. You may think that you went through and caught everything and you were diligent, but it may just be you didn't know something was deductible. And that's where the professional comes in. They look and they say, oh, look, I see this line item here. Did you deduct that last year? And you say, no. Well, good news. If it's deductible, not only can they take care of it now, they can go back and address it in earlier years if it's big enough to make a difference. So I would say a record keeping thing could be really good. And if you are uncomfortable with generating those two statements, you could always talk to a bookkeeping service and they can make it for you. We do that. And it's a service that we provide because it helps our tax pros in the end, and it helps the customer.
Jody, anything to add?
No, spot on. Carl nailed it. So excellent response.
Well, thank you. We're coming up to the last question, and oddly enough, it does not come from a business owner. It comes from a nonprofit that helps small businesses. So what a great way to close this webinar. And this person asks, how can we best support business owners in understanding what tax advantages are available? I found lots of jargon that makes this information inaccessible and not understandable for some small business owners. Carl.
So this is really my day job. This is what I do. I take this jargon and this stuff and I try to make it relatable. And my advice is generally we want to tailor whatever we're saying to whomever we're talking to. Not every business owner is on the same level. Some are very sophisticated, some are just starting out and have no financial background. So the first thing is make sure you know who you're talking to because you don't want to insult somebody by, dumbing something down and they're like, "No, I perfectly understand this. You don't have to talk to me like that." Whereas you also don't want to scare someone off by being at a higher level than what they are. So first is you want to develop that who you're talking to. Next is once you know that, you can ground your advice and what you're talking about in at their level. So let's use the qualified business income deduction as an example. If I'm talking to a content creator who didn't know they had a business and they came in and they sit down at the tax desk and I've just now dropped this bombshell on them that, hey, your TikTok channel that has 1 million followers, that's a business. And they're like, what? They're going to be very surprised. And they're already going to be worried because they're not going to understand that it's not the end of the world. It just means a few extra things, but it might be to their benefit. And so I'm going to start with, hey, there's this thing called the qualified business income deduction. We call it QBI. And what it does for you is it gives you essentially a 20% deduction. And if they kind of are glazing over at that point, that's probably where we stop, talking about it until we get them up to the level of understanding more business things. If there seem to be tracking, then we might go a little farther depending upon what their income is. If their income is in a point where they might be getting to those threshold limitations, we might add a little bit more and say, hey, just so you know, there's some limitations that go onto this. Don't worry, I'll calculate them for you. We'll figure out the deduction amount. You don't need to know what the nitty gritty amounts are, but you could ask me any questions and I can handle it. And we just kind of move it along as they kind of educate themselves. And as they listen, we can kind of progress the relationship. And so, really, the goal is just to make sure that they understand, but also not overwhelm. And I found that it just takes a little bit of work at the front end to really figure out who you're talking to. Once you've done that, it's really not too bad.
Well, thank you. We're now at the time where we kind of look back and think, all right, is there one thing that I want to bring across to close this webinar? I'll start. Uh, what I've learned here is that tax advisors aren't just there to make sure that IRS doesn't give you a penalty. They're there to help you grow. Jody, how about you?
Yeah, very informative. I would say, as a small business owner and an employee of Block, if you will, H&R Block, I can't stress enough to know you, like know yourself, know your business, know what you want to do, so you can have those conversations with someone like Carl, so you can meet with people. Because I love how he said you've got to bring the conversation down to the level of the person you're working with. That doesn't mean they're not smart. It just means they're not trained in tax. They're not trained in business side of it. So I would say know yourself, know what you want to be very honest with that partner or that person so they become your partner, and learning how and what you need to grow and where you want to be.
Thank you. Carl, is there anything that you would like to cover that we haven't covered already? And thank you for being with us this afternoon.
Yeah, I'd say most problems that business owners have is not being proactive. Um, if you get a letter from the IRS, if you get a notice from the state, anything like that is, if you get it, you shove it in a drawer, then it compounds and it becomes a bigger problem. I would say when we're dealing with these things, they can be scary. That's understandable. But just know that you have people out there that are willing to help. Block advisors, our goal is to make it to where you get to run your business and you don't have to worry about these things. We worry about these things, we take care of it, and we make your life easier. So again, being proactive, staying on top of things, but that doesn't mean that you have to do all this extra work.
Well, thank you for tuning in to this webinar. I hope you learned as much as I did. And thank you especially to Jody and Carl for giving such fantastic information.